Harmon, I can't hear you anymore. All right. Uh, I still can't hear you. I see your mouth moving, but I can't hear you. Everyone, I want you to write this down. What Harmon just went over is one of the first steps that we do when we sit down with a client. The first thing we usually go over is education. And we go over some financial concepts and some ideas with that person. The second thing we do, and this is exactly what Harmon mentioned, is we go over their goals and their data collection. Data collection. And in here, we get a very good idea of what do they have in savings, okay? And what are they able to save for their goals? What are they able to save for their goals? And then what we do is we come up with a solution for that family, okay? And that solution is called a illustration. We're going to look at an illustration for that family. What I'm going over today is actually this step right here. How do you run an illustration? And also, how do you explain it in a very simple manner? So I want you to write that down in your notebook. I want you to write that down. Step number 1, education. Step number 2, their goals and the data collection. And step number 3 is a solution, which is our illustration. Now, those of you who are licensed, you will already have this software. Those of you who are not, you're going to get a chance to learn about the software. I usually, and I would say 80% of our clients, we're going to do something called a universal life for them because it's the most versatile and it's the most, one of the best plans that they can get. Okay. So this is what comes up when you do a universal life. Okay. I'm going to go over a couple of very important keys over here. Okay, I'm gonna cover some things. The date of birth you put into here, where it says client number 1, and their date of birth will pop up here. You always want to know the gender, male or female. Of course, you're gonna do that in the data collection. And very important, do they smoke or do they not? Are they a smoker or are they a non-smoker? Anyone on the call, why do you want to know if they're a smoker or non-smoker? What is the difference?
The premiums are different for both.
More expensive.
It's more expensive. I think that's the same thing. If you are a smoker, it is more expensive. The rates are higher for you as well. Okay. Another thing you want to look at is right here. It says amount. This is the amount of life insurance. Okay. And it says reference premium right over here. Now, I'll show you how I would run the illustration. Let's say they are age, let's say 35. And let's say this is a female, okay? And let's say this person can save $250 a month into a plan like this. I'm going to give you a little bit of an idea. So what you're going to do, you're going to click on reference premium, and you're going to put in $250 over here. And what the computer will calculate is based on $250 a month, this person can get up to $662,000 of life insurance. This is how you find out. If they're saving $100, what is the maximum they can get? Okay. And a lot of times, if they have a mortgage or a young family, I always recommend to do the maximum they can get, whatever the case might be. Okay, so let's say we give this person, we can change this too, by the way, let's say $600,000 for this 250. What I do then is I go over here and I click on face amount. And what I do here is wealth maximizer option. And what this will ask the computer is basically right over here, in 20 years, how much insurance coverage do I want this person to have? What is the floor amount they're going to have? Okay, so I can change this from 25,000 to, let's say, in 20 years, their mortgage is going to be paid off. The kids are grown up. They no longer need $600,000 of life insurance. Here, I can drop it down to $300,000 of life insurance coverage. So they go from 600,000 to 300,000. Can anyone on the call tell me why would you want to do this versus giving them flat 600,000 for the rest of their life? What do you think the reason would be?
I believe it will
Will
help
increase the
to.
saving amount.
Increase the amount. I know I was going to say the same thing. Exactly. It will increase their fund value when
Yeah, fund value.
the insurance, and they can actually increase their fund value. You don't have to do this. This is just what I do. Okay. So I'm gonna erase this. Now I have a very good base on what the life insurance is. I always add a rider, and the rider I always add, no matter what, is called a critical illness rider if the client can qualify. Okay, this is a term 20. It covers 25 illnesses. By the way, you can choose. You can do 4 illnesses, which is cheaper, or you can do 25 illnesses. Okay, so let's say we give this person $50,000 for the next 20 years, and it will cost them only an extra $23 a month. If we do it for illnesses, that $23 goes to $18. So it's only a $5 difference. I would say go with the 25 illnesses, okay, over here. So now we have the coverage right over here. We added the coverage. Everything is pretty much done. The next step I do is I change the investment rate. You see where it says 4% here? I usually keep it at 6%, which is very reasonable. By the way, I'll show you the investments as well. And then we go over here and we can pick specified. This client wants to save $250 a month into this plan. Okay, so we're all done on page number 1. We have the coverage, we added life insurance, we added the critical illness protection, we changed the 6%, and we added the specified amount, how much they're saving each and every month. Now you're gonna go, Harman, yeah, go ahead. You have a question?
Yeah. So why would we not look at for how many years do we have to pay? I would not want the client to pay for 65 years up till age 100. So would we want to go look into this part as well, or?
We can change that as well, but I'll show you why I never do that. Because
Sure.
the fund value grows a lot, and we can pick how long they actually want to pay for. So that's another
Okay.
thing. I'll cover that when we go to the illustration. But the next thing here is the investor profile. And in here, you can find out which funds you should be putting them into. I'm not going to cover this too much, but I'm going to go straight to the investments. There are many investment options that we can choose from. If I go here, there are many index funds, okay? And a lot of times I use the US DAC account over here. But remember, there's a lot of other funds. There's also guaranteed interest accounts in here as well. 1-year term, 5-year, whatever the case might be. So you can choose these. I usually do this. If you want to find out how much the return is, you click up here. It's called Learn More, and it will take you directly to the return over here, updated return. Can you see the updated return right now? Or are you still on the illustration? Illustration? Okay, I'm going to reshare my screen, and you'll be able to see right here. So once you click on this, you can look at all of the funds, and you can choose. I usually do a US DAC account over here. And what you want to mainly look at is the return over the last 10 years. So over the last 10 years, right over here, it's been 16%. Remember, what did we run the illustration at?
6%.
6%. So all the numbers I'm going to show you right now are based on 6%, not 16%. Okay, so I'm going to show you guys what this looks like. I'll stop share right here, and I'll go back to the illustration right over here. So I can choose the funds over here. What you want to do is you want to go on to results. And this is what will show all the numbers based on 6%. So have a look at this. Based on 6%, right off the bat, they start off with $600,000 of coverage. They're saving $250 a month, which is $3,000 a year. And here is their accumulation fund. Okay, this is the money they have invested. I want you to pay attention to the year 20. Okay, Harman, do you have a notebook?
Yes, please. I'm writing notes.
Okay, if you can you please write this number down? $72,000.
Yeah, written.
$72,000. So I'm going to go over a couple of these numbers and what these mean. So, of course, this is the client's age here. This is their annual premium. This is what they're putting in a year into this. And by the way, this is their return. This is including a bonus that IA gives to you. Okay, so remember, we ran this at 6%. IA is adding a 0.79 bonus on top of your return. Okay, by the way, the 16% I showed you is net fees. Fees are already cut out of that. That is net of fees. Okay, very important to know. What I want you to look at is 72,000. This is their accumulation fund. Okay, I personally, a year and a half ago, I started another universal life for myself. Just 2 days ago, I called into IA. I asked them what my accumulation fund was. I already have $20,000 sitting in that fund. Year and a half. Just in a year and a half. Okay? So, of course, this is very important. Extended insurance. What this means is if the client stops making their payment at this point, how many years will this policy run for without the client making a single payment? So, Harman, this comes back to your question, okay?
Understood.
Why would you run this forever versus a certain number of years? You already, within year, I think 15, they never have to put money into this policy again. It's paid off at this point, okay? So, Harman, I want you to note down two numbers. In 20 years, $72,000. And at age 65, which is in 30 years, $144,000. Please note that number down. Now, here's how you explain this to a client. This is very, very important to understand. And this is where the client is going to compare, is my money better in a bank account or is it better in this account? Where should I put my money? I know sometimes Juliana asks me, how do you get clients for $400 a month and $500 a month and $1,000 a month? It's just value, okay? If you show them the value, they will put the money in without a doubt. So here's how I show this value to the client. And I'm gonna share my screen once again, and you'll be able to see I always use something very simple like the 4 boxes. I just use this tool right over here. Are you guys able to see the 4 boxes? Okay, yes. Fantastic. So here's how I would explain this to the client. I would say, Mrs. Client, okay, since it's a female, I would say you're saving $250 a month. Okay? We have growth on this money. I ran this policy at how much? 6%. So remember this, the $72,000 I'm showing her is based on 6%. Okay? This fund has returned an average of 16% net fees over the last 10 years. Another thing is safety. Is my money safe? You are invested in 15 to 20 of the top companies in the US. That means if one company goes down, the others are usually up. This is why the average return over the last 10 years is 16%. Your money is spread in many, many different companies. Now, remember this, all the client cares about is what am I putting out of my pocket and what am I getting, okay? So the client is saving $3,000 a year, okay? 3,000 times 20 is $60,000. So in 20 years, this client put in $60,000 out of their pocket. Harman, how much did they have based on 6% in this account?
Sorry, could you repeat that question?
How much did they have based on 6% in 20 years?
72,917.
$72,000. So they put in $60,000 and they have 72,000 more money than they ever put in. By the way, at this point, can the client take their money out? Yes, they can. Can the client cancel the policy and take all of their money? Yes, they can. Okay. Now, at age 65, in 30 years, the client would have saved into this account 3,000 times 30 years, $90,000 out of their pocket. Harman, how much did they have in their cash value?
145.
$145,000, more than 90,000. By the way, this is based on 6%. If the market returns 16%, this might be 100,000, and this might be $250,000. Big difference. Okay. So another thing, this is not the only benefit of this account. They have a life insurance benefit from day one of $600,000. And they have a critical illness benefit over the next 20 years of $50,000. Okay. Now you ask the client here, where is your money better off? If you put it in a bank account, do you get much growth there? Not really. Another question is, in the bank account, do you have any life insurance? If something happens to you, what does your family get? Maybe not even the bank account. Okay. So this is why I mentioned that if you explain it in this way, where they have growth in this account, they have safety, they have tax advantages and protection, it's a no-brainer for the client. The client's literally looking at this, oh my God, my paycheck every month is going into a bank account. It's not even giving me anything. Why don't I put it into this account and I have way more benefits? By the way, not everybody can get this account. I want you to write that down because it's so important. Some people are uninsurable, meaning they can never get this account even if they wanted to. Even if they wanted to, they could never get this account. Another thing I want you to write down is wealthy people in Canada use this account more than anyone else. When they maxed out their TFSA, when they maxed out their RRSP, guess where they start putting their money? Into insurance. Into insurance. So I look at this. Yes, this is insurance. Yes, you have a life insurance benefit. Yes, you have critical illness benefit. But the way that I look at it is it's a great investment as well. Plus insurance. You're getting a great investment plus insurance. Because remember this, in the bank account in 20 years, all they would have had is $60,000. And no life insurance, no critical illness. In this account, they're going to have $72,000 plus life insurance the whole time, plus critical illness the whole entire time as well. It's a no-brainer for the client. So this is how we run the illustration. I don't show them these numbers. I show them in a very simplified manner. And by the way, in 20 years, if they never want to put money into this policy again, they don't have to. If they want to increase it from 250,000 to 250 a month to 500 a month, they'll have an even better retirement. So I'm going to show you that number before I continue. Let's say this client, instead of 250, puts in $500 a month into this plan. In 20 years, instead of $72,000, they would have saved almost $200,000 in this account. At age 65, at retirement, they would have almost $500,000 saved up in this account for their retirement. So a lot of people, they have a lot of money sitting in a bank account. They have $20,000, $30,000, $100,000 just sitting around in a bank account doing nothing at all. What you can educate them, you can guide them. Hey, start putting a little bit of that $20,000, let's say 300 a month, start converting it into this account. From day one, you have insurance benefit. Day one, you have critical illness protection, and your money grows. And by the way, in 20 years, if you don't want this account, cancel it. Take all your money back. This is how you do a plan like this. And by the way, the importance of what Harman mentioned, collecting their data is so important because from their data collection, you will learn, hey, I have a TFSA that has $10,000. I have a RRSP that has $30,000. There's $40,000 right there that they can start funneling into a universal life account, and it will benefit their family a lot more. All right. So this is how you run the illustration. It is so simple. It is so clear. And this is how I explain it to a client. And a lot of times, even Juliana was mentioning, she was saying today, you don't have any objections. How can anyone object? It's a no-brainer. So I want Juliana to share some questions that she's going to cover, and she goes over as well. I want to congratulate her over the last month and a half. She earned around $25,000. And that's a big, big income, okay? All by doing this, all by sharing this information. So Juliana, floor is yours. Go ahead.
Good evening, everyone. I'm really, really excited, actually, because that's my favorite topics to talk about. And since when we discussed with Parm that he doesn't have objection most of the time, the reason why, because of his experience, knowledge, as well as a confidence. But that's not the case for someone who's new, and also for someone who just got licensed and they don't have enough experience, and they think in their head that they might have some kind of questions that can come up from a client, right? So in this case, I want you write down 10 questions that client can ask. And in case, if you don't know how to answer those questions, you always have those on your notebook or on your phone. Write it down, okay, and remember those answers. So it will help you out with client steps. So first question that they might ask, and you should ask sometimes clients as well, because you have to lead with conversation, right? You have to bring value to the client. So you have to ask questions like, number one, do you have an income protection benefit, right? And till what age? Is it till age 65, right? What amount you're gonna get monthly? And is it tax-free? So second question you can ask, how much money you will get if critical illness, it didn't occur and you didn't die? How much money you will get, or your family? Is it tax-free? Third question, you can ask, for how long you're gonna have those benefits? And fourth question, do you have a tax-free retirement strategy for yourself and your family? And my favorite last question you can ask about, can you transfer those accounts? And also, can you create a generational wealth? So that's really, really important. Also, sometimes client will tell you, you know what, if it's such a good account, why I never heard about? Okay, no one told me about this account even exist. And that's what actually I see most of the time, people saying, you know what, never heard about, why it's such a great account, no one showed it to me. Now it's person disabled, they can apply, they can get it. So how would you handle those objections? First of all, you can ask, have you ever had access to the financial advisor? Have you ever been financially educated? Okay, and client will say no, obviously. Then obviously you never had a chance to learn about this account exists, right? Also, sometimes client can, even you show them a plan, you explain everything great, and clients still think, oh, you know what, it's so good, but I need to think about. That can happen too. Remember one thing, the small yeses, it's really important. small yeses. If you ask, do you think this really important account to have? Do you think it's really important to have a critical illness benefit, just in case if cancer, heart attack, stroke happen to you and your family? Do you think your family will be prepared in those cases? So small yes is important because it will lead to big yes, which is client will be agree in the end of the day that they need to apply this account as soon as possible and have those coverage as soon as possible. So when clients say, you know what, I need to think about, you should say yes, you should think about. That's really important to think about. But remember this, I don't know if you even qualify for this account. So let's first apply and see if company will approve you. And then you're going to have 10 business days to think about. By the way, the application cost free. So you're not going to pay for application. It's cost free. And then you can think about, right? So client would not have any issue to apply. And then knowing that 10 business days, they can think about, right? And when client get approved, guess what? You're going to call client and say, congratulations, you get approved. I'm really happy. And now your family covered and so on. So if clients say, you know what, I'm not sure, I need to think about or talk to someone or my wife or all of this, it's like, I understand. That's really, really important to ask your wife or husband about this. But remember this, you reminded the client, this is your benefit, by the way. And this is your family benefit as well, which is critical illness. That's your benefit, tax-free. And this is your family tax-free benefit, which is death benefit. So ask your wife or spouse or husband about if they okay if something happened to you or or to your income, how they're going to handle this. Remind the client again that this is their benefit and you just doing your job, okay? So also what I want to mention that when you're talking about this client, remember this, client don't care about how much you know. Client don't care even about how good product is. What client cares about, how much benefit they're gonna gain, and also how much you care about the client. So when they know that, okay, this is my benefit, this is for my family, this is, I need to know of this and I need to have this account, they will see the value, of course. And you should not hesitate in the end of the application or in the end of the process, client, to ask for referral. And how can you ask for referral? Not telling them, okay, give me a phone number, someone that you know, or a referral or so on. You can ask a question back to the client. So do you know anyone in your family or in your circle that don't have those type of account? Do you know anyone that can benefit from those accounts? Since you never heard about this account, since you never were financially educated, do you think that your family will benefit from those accounts if I provide service to them? If you can mention about that this type of advisor did this type of account and I have such a great plan for myself, you should actually reach out to this advisor. So client won't hesitate. And if you tell them this is really good for you and probably for your family, they will be agree to talk about this plan. That's how you can actually get a referral and you don't have to look for a clientele in the future. Go back to you, Par.
Okay, thank you so much. All right, great job. That's one thing. I hope you guys saw my whiteboard. I did put some of the questions on that whiteboard as well. I think that's another thing that you guys should be sharing with people, and you should be sharing about the referrals as well. A lot of times when we ask for referrals or whatever the case might be, the question you should ask is exactly what Juliana mentioned, where do you know anyone that should have this account but does not have it? And a lot of times they have their brother, sister, mother, father, whatever the case might be. I know recently a lot of Juliana's clients have been referral as well. And this is how that she's been doing it, where it's one client, but then it can multiply into 4 or 5 clients all at once. and then you have a lot of business to write too. So other than that, I shared the illustration today, gave you guys a little bit of an idea of how it works, how I run it, and how you should be explaining it. If you explain it in this way, it's so simple, and they're comparing it to a bank account, it's a no-brainer for them. It's a no-brainer. The only question is how much do they want to put in? Okay. And Juliana shared the questions as well. I want to mention to everyone in our group chat, I did send our new weekly training schedule. Okay. So every Tuesday is going to be skill set, and we're going to be talking about communication skills, illustration, product, software, a lot of these things. Tomorrow in the office is our entrepreneurship class with Peter Johal. Okay, those of you who don't know Peter Johal, he's the son of Terry Johal. They make $4.5 million a year in WFG. All of you should be in the office. If you're not in the office, attend via Zoom. Okay, so it'll be 7 to 8 o'clock. Everyone should be there, and I'll see you guys all tomorrow in the office or on Zoom as well. Okay, see you guys. Good night.